Yeah, if anything, I'm more bullish than ever. I did raise targets back in October in my fourth quarter letter to 9,500 on the S&P. So I was far above the street already, and my work just says it's going even higher. So you're looking at a very unusual, maybe unprecedented rally. It's the end of what I keep saying. It's the end of a 43-year secular bull market, and at the end, you usually get some fireworks, and that's what I'm expecting.
Hey everyone, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back the one and only David Hunter. So David is the chief macro strategist of Contrarian Macro Advisors, and one of the few people who's been bullish over the past few years and has been very correct, even though people have doubted them. So David, thanks so much for coming back on the podcast.
Yeah, hi Anthony, great to see you.
Yeah, looking forward to the conversation. As I said, you've sort of been very bullish the past few years, and it's been correct. And you keep raising your prices, your price targets, and they keep getting hit. So, really interested to hear, what are you currently seeing and what has changed over the last 6 months?
Yeah, if anything, I'm more bullish than ever. I did raise targets back in October in my fourth quarter letter to 9,500 on the S&P. So I was far above the street already, and my work just says it's going even higher. As you remember, I raised it when we got hit in April with the tariff news, and the market dropped 20%. Sentiment got so negative, I went from 8,000 to 8,700, and now have increased it again from 8,700 to 9,500. And I think it's going to be a first part of next year's story. We'll probably have a pretty healthy year-end rally, but I'm thinking right now. I tend to focus on obviously the bigger picture, but right now I think there's a setup there where we could have a 3 or 4% pullback here to retest the lows of a couple weeks ago. So we're close to where I kind of targeted maybe a week ago that we could rally to and then have a pullback. I don't expect a full retest where we go back to the lows, of then, but we could see 3 or 4% down in the indexes, and then I think it's off to the races. So probably from somewhere mid December to the end of December should be a typical year end rally, probably a strong one, and then carry right into the new year. So I think first quarter will be a very strong quarter for stocks. Obviously I don't know exactly when we're going to hit that target. From here, it's over 40%. And from the correction lows of the pullback lows of maybe a week from now, it's going to be more than that. So it's a hefty run. Could happen in as I say, the last part of this run is going to be parabolic. So it could happen in a matter of just 2 or 3 months, or it might take a little more than that. But either way, I think the first part of next year is going to be very strong. Same thing with the Nasdaq. I raised my target there from 30,000 to 32,000. Raised my target on the Dow from 60,000 to 65,000, and on the Russell, which I think is going to lead the way in this last run to the top, I raised my target from I think 3,400 to 3,800, which is well over 50% from here. I think so. So you're looking at a very unusual, maybe unprecedented rally. It's the end of what I keep saying. It's the end of a 43-year secular bull market, and at the end, you usually get some fireworks, and that's what I'm expecting. So um, people kind of look at those numbers and go, the economy's slowing, rates are sticky, inflation's sticky. How can you be so bullish? Well, I expect over the course of the next several months for rates to come down and come down quite nicely, for inflation to continue to trend lower, for the economy to hang in there long enough to make it look like there's no recession coming, or at least anything's going to be a soft landing. That's not my view for later next year, but it is. I think it will be the picture for the next few months. So I think there's plenty of room for investors to kind of abandon their skepticism. They've been fighting this thing for 3 years, 3.5 years, and they obviously they're invested, but they're cautiously invested or skeptically invested. And even now, you hear people talking about how much more can it go. It's valuations are high, earnings, although earnings might be better next year, multiples are at kind of the historic highs. So there's still a lot of skepticism in the market, and that is what I call the fuel for the final advance. The wall of worry that I think will keep fueling this thing. So I'm bullish for sure, and like I said, the next week or so uh, could have us go the other way, and people get even more bearish. But it's just a pullback. It's not a full retest in my opinion, and I think it's an opportunity to get on board if you aren't already on board.
Yeah, really interesting. Thanks for laying that out. So you've been, as you mentioned, you've been very bullish the past few years, and I think every time you've had to sort of increase your price target, you've had to go, you assume there is going to be this sort of blow blow off top, and then from there we're going to see quite a big crash. Could we just continue to sort of slowly float up as we are? Well, not slowly, but continue to float up in the direct trajectory that we're going at the moment. Do we need that blow off top? Do we need that crash? Can we just continue to keep going?
Yeah, I don't think anything is necessarily needed. It just all my analysis from both fundamental and technical macro sentiment and cross markets, they just all argue that we are late in this game and that the final move is going to be a strong one. As I say to people, because people want to put deadlines on this, I go, there's no deadlines in the market. If it wants to keep going, I get accused of pushing my timelines out. I don't have a specific timeline. I do, give guesstimates of how long this might take to get there because I do expect the final move to be parabolic. So parabolic means it's a lot of ground gets covered in a very short while. So that's how I can look and say 40% could be covered in, or 40 or 50% could be covered in 3 or 4 months. That's not normal. Normally that's 3 or 4 years worth of coverage, but it's where we are in the big cycle. That is why I say that. And it's also, my analysis just points to that. A lot of technicals point to that. So, but there is no magic to, there's no timeline where all of a sudden the clock strikes midnight and you turn into a pumpkin, or the market has to crash. So if people want to stay skeptical, and the economy continues to kind of plow along, it can stretch out. So people need to understand that when you're a macro strategist, you're not making a trading call. You're not saying this is what's going to happen in the next. You're just kind of putting out the big picture and then giving some kind of an assumption of what that might look like, not what it will look like in terms of time frame. So yeah, could other things happen here that stretch it out? Could you have a longer consolidation that gives it more room to run after that consolidation? Sure. I don't think that's likely. All the technicals certainly point, in my opinion, to this quick pullback and then off to the races. And I think once we get off to the races, it may be straight to the top. That doesn't mean you can't have 2 or 3% pullbacks along the way, because you can get those anytime. But pretty much, no big consolidations. I think after this pullback is my guess. Again, things can change that, but I just too many people want to just look at the market and say it's high, so I'm skeptical. I'm bearish, and I just right now that's not the picture. Of course, I am my as you say, the other side of the mountain. My call is for an 80% bear market, so I do see trouble on the horizon. I just don't think we're there yet.
Yeah, okay. Interesting. And gold and I guess precious metals are other assets that have performed very well over this, like, especially the past 6 months or so this year. What do you see there? Do you think they can continue to run as they have?
Yeah, I think gold and particularly silver look excellent here. I am as bullish as I am on equities. I'm more bullish on the metals, or certainly on silver. Silver, to me, is just breaking out. It went to all time new highs in the last month, and consolidated those highs, and now looks like it's ready to run. The miners, same thing. In terms of consolidation, I think that consolidation, there's always a chance here in the next week, 10 days, that if there's something out there that's going to cause the pullback in the equities, it could also have the miners sell off here, or the metals and miners sell off. But it's that one's not as clear. I think the equity market, even though that setup doesn't have to happen, it's pretty clear it might happen. Silver, certainly here could just keep going here. It could be a rocket ship here in the next few months. So my target on silver was raised in that same fourth quarter letter from $75 to 100, and I think we'll be there. Certainly, could be in the next 4, 5, 6 months. And gold, I raised from I think I was at 4,000, raised it to 5,000. I don't remember exactly when I did that, but that one, I think is conservative. It could push right through 5,000 given where it is. So both the metals look really good. The miners look really good. I raised targets on some of my silver and gold ETFs, the miner ETFs. So I use those just to kind of give a target for the miners. My GDX target was raised from 75 to 120. My GDXJ, which is Junior Miners ETF, was raised from 100 to 170. My SIL is the large cap silver miners. I raised that from 75 to 150. My junior miners, SILJ, I raised my target from 35 to 60. So you can, and like I said, those are pre-bust targets. I'm calling for a bust later next year, sometime next year. But prior to that, I expect those targets to be reached. So you look at the numbers on those, do the calculus on those, and you see that there's an awful lot of upside if I'm right. So I think we're in the sweet spot for the miners. Obviously the metal price moves up and the miners make more money, and that's where we're at. And surprisingly, institutions are just beginning to warm up to the precious metals. They may have some gold, they have absolutely no silver, and that's just happening now, where they're starting to notice the performance and say, well, we maybe need to have a little bit of that in there. So whether it be the metals or the miners, the institutions really haven't been big participants, and I think that could be part of the impetus for those big moves.
Yeah, and it's sort of it's basically been a 10-minute, sorry, 10, not 10-minute, 10-year sort of bear market for many of these miners, or not bear market, or just sort of a range without breaking out, and they're finally broken out. So I imagine that means,
They had huge moves in the first decade of this century, back particularly between 2009 and 2011. They had big spikes, both gold and silver miners, and then they went through a long consolidation that lasted several years. Started picking up back in maybe 2016, but were frustrating to investors because they'd start to go, particularly the silver miners, and then they'd give it back, and so people kind of got frustrated with the managements of the miners. They tended to, just when things got good, they went out and raised capital, diluted their stock, and failed to deliver on things. People had expectations and they wouldn't meet expectations, or would underperform. So it was a long slog, and only really in the last couple of years have they gotten going. The gold miners first, and the silver miners more of late. But there is really so much there to like, and I think it's going to be, and this is unlike the equity market, which I'm calling this a 43-year secular bull market top that we're heading into here in the equity markets. Silver and gold, this is a top prior to the bust. Most everything will get hit in the bust. So they'll get. You could see 40 or 50% hits to even the metals, and more in the miners. But the other side of the bust, they will be part of the leadership that takes. The market, the indexes may not get back to these highs for decades. The highs we see next year in the equity markets may not be revisited for decades. On the other hand, the metals and the miners, I think, will have a very big move next cycle. So that I'm calling for 20,000 gold by sometime in the early 2030s, 500 silver, and a lot of commodities I think will do very well, because I think post bust it's going to be a commodity cycle that will lead.
Yeah, great. And what do you see in the other industries? I know you cover semiconductors, you cover quite a few other industries. How are you tracking those, and what are you seeing?
Yeah, I think the leadership this cycle hasn't changed. We're going through a pretty good consolidation in tech right now, particularly the Mag 7, which had been so overowned and popular. There's a lot of people saying that's behind us, and I do think, as I said, the small caps might outperform that into the top. But I still expect semis to do very well. Still expect most of the Mag 7 to do very well, and tech in general to do very well, AI to pick up again. So the leadership will not change until we go into the bust, and then I think coming out there'll be new leadership next cycle. But I still expect good things for tech and semis. I also think financials will play very well in this last run to the top. They've been a little bit slow here for the last month, so people are getting a little bit soured on them. I'll tell you, the picture I see is that they are putting in very high level consolidations, not far off their tops, and they're ready to run again once we have this pullback. So I think financials will play, industrials will continue to play into the top. I think the basic industry, materials should do well into the top, which includes copper. Copper looks very good here, I think. And even things that are interest sensitive that have been hit, like housing, I think the home builders look like they have one last leg to go. That may be hard for people to understand because they've disappointed here for last several months, and they look like they're done. But I think they're building a rounding bottom here, and I think are going to go on to new highs. It will be driven by lower rates. I'm very bullish on the bond market here. Short term, I see the potential for the setup there for the 10-year to go from wherever we are now, 405, 406, back up to say four and a quarter, 430, might even get to 435. So that might be the impetus for the pullback in the equity market. If the equity market drops 4%, it's probably because the bond market's selling off. So we're a week away from a Fed meeting, and everybody's assuming the Fed's going to cut. I think that's probably a decent bet right now, but it's always what comes out in terms of Powell's post cut, you know, press conference, and he could disappoint there or talk about being cautious or whatever. So whatever, or it may be speculation leading up to the meeting that causes a sell off, and then you get good news at the meeting. I'm not really too concerned about what the next week or 10 days looks like. I think we'll get a pullback one way or the other probably, but if we don't, we don't. But I am, once that little backup in rates happens, if it does happen, I'm very bullish bond market. I see maybe in the first quarter, certainly by the second quarter, you could see 3% or below on the 10-year. And if you get that, obviously that will help mortgage rates, and it'll be going into a spring selling season. So you could get one final hurrah in housing, not to new highs for homes themselves, home prices and activity, but for the home builders, they could get a surge in activity and run their stocks up. So I do think home builders will play here, and anything else in the financial area will benefit by lower rates. So banks look very good, stock brokers look good, and other than that, the area that has caught everybody's attention recently is healthcare and biotech. If rates come down, that's going to benefit biotech for sure. Healthcare, I'm less sanguine about. I think there's, they may continue to play here, but I think they had a big part of their run. They had lagged for a long time, so they caught up some. That's not that they'll go down in this last run. It's just not where I think you're going to see the leadership. They may play. I think the market's going to broaden out, so an awful lot of things are going to play in this last run. The things I'm not bullish on, the things that I would not expect to play out very well are energy. The oil. I still think oil's going lower. Um, Not necessarily, could be in a trading range for a while, but in the bust, I expect oil to go to $30. So there's still plenty of downside in oil, and the energy area is just not an area where I would be expecting much. Um, Utilities will play if bonds play, but they're obviously a lower. They're typically not going to deliver the kind of returns you're going to get from tech or industrials or financials.
Yeah, okay, thanks for laying that out. What would you say is your most contrarian, you know, prediction at the moment or thought?
Yeah, at the moment, I guess probably the bond call is probably the most contrarian. I don't think people are all that bullish on the bond market, and certainly won't be if we get a backup in rates. Um, I'm not at this point, and this is how people misunderstand. I'm probably the most contrary strategist on the street. My calls over the last several years have been oftentimes laughed at or ridiculed for being crazy and stuff. So I'm used to being out of the mainstream and away from the consensus. But there is a period when the consensus and I are not far apart, and that's kind of where we're at now. Where I don't think my numbers are way out of consensus. My targets, but in terms of the market going higher, I don't think right now. Like I said, the strategists and institutional investors are somewhat skeptical. The retail public is pretty bullish, and even the institutions have gotten the momentum of the tape pulls people in, so they're not overly bearish. They're just not. They're not all in. Um, and on bonds, because rates have come down some, from 450, 60 a few months ago. Um, they're not overly bearish on bonds either, but they're not looking for 3% or anything like that. So that's probably my most contrary call right now. Um, I think people have jumped on the bandwagon with gold and silver, so I'm not contrary there at all. There are people telling people to take profits, um, and I think that's a bad call for the metals, but the majority I think have the momentum in the metals has gotten people's attention. So the majority there I think are on board in terms of being bullish.
Yeah, it's really interesting as you're saying, the further on through a cycle, the less contrarian a lot of your estimates are, and we've definitely seen that over the past few years that we've been talking. Um, what do you see? So obviously sorry.
Where you'll see the contrary call again is at the top. When I'm turning bearish, I suspect what you're going to see is everybody's going to be all in. So that's the MO for me is at turning points, at major inflection points. I have no company. I'm basically alone. And then as the thing moves towards the other extreme, I become more consensus, or the consensus joins my call. And then at the other inflection point at the top, I'll be calling for a big bear market, and they'll be saying, "No, this thing has legs."
Yeah, great point. We have a mid-election, or there's a midterm election coming up next year. So, and there's talk about, giving stimulus checks from tariffs to individuals. So imagine if that were to happen, you'd expect the market to potentially, prolongate even further with that increased stimulus.
Yeah, I've had a lot of people ask the question of, could that change your forecast? Could that stretch out the cycle and or even eliminate the bust? And I remind them it's a global bust, first of all, so it's not just U.S. centric. Um, and number two, I think the reason I'm calling for a global bust is because of excesses that have built up over decades. It's not just the last couple of years. So could prolong things for weeks or a month or two. But I don't think it changes the ultimate outcome. I still think we're heading for something pretty dire, simply because you've got far more leverage today than you had in 2008 9, and there are issues out there that it's not just U.S., it's around the world. The economies are not in great shape. Even the U.S., if you look, and we just had Black Friday and Cyber Monday, and the numbers came through as they always seem to with growth. Some pretty good numbers. And so it looks like we'll have a good Christmas probably for retailers. And it looks, so you look and say, oh, the economy's not so bad. The consumer's in better shape than I thought. Maybe not. Maybe what you'll see is that they're trying to stretch their dollars. They don't have, particularly it's a have and have not economy. So you've got the people at the top end have plenty of wealth and have plenty of money to spend, and they're kind of keeping things going. The people in the bottom half are just trying to make ends meet. So they're taking advantage of Black Friday and Cyber Monday to get all their Christmas shopping in when they know the prices are the best and they can stretch their dollars. So so that's part of it, and the other part is just as we go forward, there are signs that more and more people are becoming constrained. That the debt numbers, delinquencies, et cetera, are starting to show signs. They're still not at the point where you get really nervous, but they are showing signs that this economy is late in the game, and that the typical strains that show up just before a recession are showing up. And so yeah, we can stretch things a bit with a $2,000 tax cut or whatever they're going to do, tax credit. um, but I just don't think it changes the major picture.
Okay, makes a lot of sense. Also, if we look at what's happening, there's really massive increases in debt, massive increases in, I guess, you know, how economies are run, fiscal dominance doesn't seem to be stopping soon. There's talk that maybe this will mean that rather than seeing market crashes, as you're suggesting, we might just see the currency being devalued over a longer period of time against real assets. So could that be a threat as well, where maybe it's not actual the value of the equities in US dollars, but it's in maybe other assets like gold or anything else where it's we actually see that crash.
Yeah, I don't think so. I mean, I've had this bullish forecast at the same time I've been calling for the dollar to fall to 82, and that's still my forecast. So I expect a dollar devaluation or dollar weakness here for the next 6 months, to and pretty hefty drop. It's been in a counter trend rally for several months now. For at least a couple months, back towards 100 or over 100, and now it's at 99. And I think we pretty much have finished that counter trend rally. I expect the next stop to head, to see the dollar head towards 90, and ultimately, as I say, 82. So even though I have that forecast, I still have a forecast that um, after this final run, the market rolls over, the economy rolls over, so that later in the year, whether it's second quarter through the into 2027, or whether it starts a little later than that, I don't know, but I don't think weaker dollars stops that. Um, and again, I remind people, if our dollar's selling off like that, versus the dollar, the euro's going up. I have a target of 130 on the euro. I have a target of 150 on the British pound sterling. I have an expectation that even the yen's going to have a good rally. The Canadian dollar, the Aussie dollar. So, so yes, it might help the U.S. to have the dollar devalued or lower, but they're dealing with stronger currency over there. So, because this is a global call, a global bust, I just don't think you're going to move the deck chairs around some, but I don't think it heads off that global bust.
Okay, makes a lot of sense. So, David, thanks so much for your time today. Really appreciate it. Last question is, what is one message you want people to take away from our conversation?
Yeah, I guess the thing I would just remind people is that this is the end of a long cycle. So, yes, we're in for some fireworks if I'm right, and it's going to be, I think, the biggest rally in history, perhaps coming up in between mid-December and say the end of March. Um, However, just remember it's the end of a 43-year secular bull market, and what follows is probably going to be the biggest bear market since 1929. Again, if I'm right. Um, so don't get caught up in because it's investor psychology works opposite to what's productive for an investor. It means that you get caught up in the tape, you get caught up in the momentum, and you become more bullish at the top instead of more bullish at the bottom. And I just caution people to know that's how it works. And when everybody's getting more bullish and calling for this thing to, go for another year or two or three, be careful, because just remember where we came from. We were at 3,500 on the S&P, back in October 2022. So we're 3 years removed from that, and say 3.5 years from now, we could be, um, you know, 2.5 times where we were back then. That's a big run. And I just want people to know that. The other thing I should say is for those that have financial advisors and or at least pay attention to what is kind of the mantra out there, which is buy and hold. This is the one time, if we're looking at, again, I can be wrong, but if we're looking at a bear market that's the biggest in my lifetime, biggest in the post World War II era, biggest since 1929, um, buy and hold means you're going to ride it all the way back down. I'm calling for an 80% drop in the indexes. You ride it down 80%, that means you could even triple or quadruple off the bottom and not get back to the levels that we're going to see early next year. So I just would tell people there are times when buy and hold works great. In the last 40 years, it has. If anybody listened to financial advisors starting in the mid 80s when they started saying, the popular mantra was it's time in the market, not timing the market, meaning buy and hold, just ride through the corrections, the bear markets, etc., and you'll do well. That was great advice. Anybody that bought the S&P index in 1985 is sitting very pretty today thanks to that advice. However, times change, and we are heading into a very different environment where buy and hold could be a real penalizing strategy. So, the industry is not going to change. The financial industry is going to stay with what brung them there. They're going to continue with the buy and hold strategy. But I'm just saying for people to think about this and understand what the implications are if my forecast is right. It means you ride it all the way down, and you may never get back to the levels of your valuations that you have, today, or certainly, in the first quarter next year. So it might make sense to look at things that will hold up in the bust and switch your portfolios around from all equity or heavily equity to treasuries. Treasuries will be one of the very few assets. If I'm right, rates are going to drop below 3 in the next 3 to 6 months, and probably head towards zero in the bust. And if we go to my forecast is a 0% 10 year, the end of next year, probably, or early 2027, at the bottom, at the end of the bust. if that happens, bonds do very well while everything else is getting hit very hard. So it's not like you have to go to cash. There are other, not very many, but there are other alternatives. So just a thought for people to kind of ponder, because if this happens, you're going to get excited. People are going to see, the news is going to be talking about it. Everybody's going to be telling you about how this is the great new world, and this is going to go on for a long time, thanks to AI, thanks to robotics, thanks to a lot of things, thanks to maybe peace in the Middle East and peace in Ukraine. Who knows? There could be a lot of things that will convince you that the next, the next few years are going to be great, and you're going to have a hard time selling. Just remember this to kind of be as a kind of in the back of your head as a conscience to say, yeah, I hear all that, but here's the other alternative.
Yeah, great. Thanks so much for laying that out, David, and thanks again for coming on. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Yeah, I am on X or Twitter. So Elon Musk wants to change it back to Twitter, maybe, but I'm on there every day, pretty much replying to a lot of people. So you can get a lot of what I talk about. My views on a day to day basis there. I don't change often. My big picture forecast, as you know, has been pretty much as it has been for a long time. So it's not like I change my views day to day. I'm not like that, but you can kind of stay with my ongoing view by following me on Twitter. Um, and then I have a quarterly letter that I put out by subscription, so there's a cost to it. Um, I usually have people just direct message me on Twitter, and I will provide details. I would just caution people in just the last 2 or 3 weeks, Twitter changed, or X changed their direct message function, and it's now called chat. It's in, they went to encrypted, and it's I just find it less reliable. Sometimes my replies go into I don't know where they go into the ether. Um, I think it's because people haven't, you have to now put in a passcode to be there, etc. I'm not sure if that's the reason, or whether it's still they're still working out the kinks. I'm not sure. So what I had said to people is, if you're interested in the letter, send me your email on that chat, on that messaging service. However, it is working better than it was the first week they did it. So I'm going to change that a little bit and say, if you're interested in getting information on my letter, message me through chat, but also include your email. So if you don't get, if for some reason my reply on chat doesn't get back to you or doesn't go through, I have your email and I can send it to you there. And I would just say, if you don't see me responding, don't be afraid to say, can you email me? Come back to me again through that chat and say, I didn't get it. Will you email me? Because I never know. I send them, they look like they went through, and I have no idea unless you let me know that you got it, whether you did or not. Now, when somebody replies again, I know they're getting it. But if they don't reply, I assume it's going through, but it's just not as reliable as it was when they had the direct message service. So anyway, that's my story.
Yeah, great. I'll put that in the description below, and I'm sure hopefully people can get in contact with you if they need. But thanks again for your time.
Okay, thanks, Anthony. Merry Christmas.